Well, while KB Home posted positive numbers for residential real estate, our next guest sees more pain for commercial properties. Activist investor Jonathan Litt is Chief Investment Officer at Land and Buildings. Jonathan, great to have you back. The hurricane is in full force, you say, specifically for office space REITs. So what is it that has, before I think you talked about the hurricane landing or it's coming, it's on the horizon, but now it's in full force. So what happened?
Right. I want to be clear. It is office.
Yes.
Most of the other office real estate categories are healthy, but office really is in a fierce storm. And what's happening is, as we talked about in the past, is financing has become almost non-existent. And we have a demand problem from tenants, and we have a financing problem. And the assets that are trading, and I was listening to the recap at KB, the sellers are providing the financing. And so you don't have market rate financing because banks aren't lending. The seller's saying, we'll give you 65% loan to value, we'll give you discounted interest rates. And so really the seller's not selling, they're hanging on to the office building.
So capital sort of adores a vacuum, and we're in a bit of a vacuum right now. How do you think you get to the sort of place where financings and transactions start happening, even though it may be at a much lower rate than purchase price or current marks or whatever it might be?
Yeah, I think that the sellers don't really want to take the big hits, and the sellers are providing the financing, and so they can keep marketing their books appropriately without taking the big hits. I think this is going to take 10 years to play out. I was looking at a statistic before I came on. There's 2.5 billion square feet of space expiring by 2030. Most of that was written before the pandemic. As that space rolls, and we've seen this since the pandemic, people are taking 15% less square feet because less people are in the office. So that's another 400 million square feet of vacant space to come in a 20% vacant market in the U.S. Rents aren't going up. Rents are going to be going down. Your operating expenses are going to be eating the landlords alive. And so the fundamental outlook's not good. The financing outlook is not good. I don't know who really steps up. I don't think the banks are going to be stepping up anytime soon. They want to get these off the books. They don't want to get more of it on the books. So I think it's just going to be a long, slow bleed. Unless everybody has to go back to the office, which does not seem to be happening.
Jonathan, first of all, I remember when you were coming on a couple of years ago, you guys do such interesting work, which included going through cell phone records of tenants in buildings and just to understand what traffic looked like. So you've called the hurricane. As an investor and as an activist and as someone that's not afraid to get in there, what's the next move on the chessboard for you? How much are you pressing these shorts? Where are there? I mean, look, there are zeros out there. And so that's, obviously very gratifying. At some point, you don't need to ride these things all the way. And I'm just kind of curious how your game theory is here.
Sure. So after the banking mini crisis we had last spring, these stocks got destroyed. There was no market cap left. So shorting traditional office became less attractive. We did short, and we talked about it in the past, and we remain short, an office lab company. And it's still, I think, incredibly overvalued. The fundamentals have gotten worse, and I think we have a chart on this, with the availability of space has hockey sticked worse. Availability has gone from, call it 10, 12% to over 22%. Since I was on the show last year, that's gone up by 4 percentage points. Boston, which is the largest market, is seeing negative absorption, and they have 9 million more square feet coming online. It's overvalued. This is going to be bleeding out for years. We do need new drugs, and we are seeing financing for new drugs come about, but people don't need to be in the lab to do it. People are working from home. They go to the lab for a few hours. They come back home. The tenants are seeing this trend. They're going to shrink their footprints as these leases come due. The cell phone records maintain about 50% of the cell phones in the buildings today versus pre-pandemic. And as long as that continues, there's a glut of space.
So we're showing the facts for Alexandria, which is your major short position, which is a lab space company that you're talking about. It's flat over the past year. So what is that moment of reckoning? What are we waiting for in order for that to trigger to the downside?
Sure, and it's been an interesting path, right? It went down a lot, it's come back, and it's off a bit from where we were. And we need to start seeing it show up in their earnings results. They've got a very substantial development pipeline, which allows them to have earnings which don't quite reflect it yet. But we think this is going to get reflected in earnings in coming quarters and years.
Do you engage with management?
We do.
Do they engage with you?
We were having a conversation in the green room before, and they do. And, the CEO thinks he's going to win, and I'm wrong, and I think I'm right, and he's wrong, so we'll see where this plays out.